Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Hold the range again. Go figure. Still holding that 2.80 to 3% range. Call last week we briefly got above 3%, but not long enough to make any difference. And if you blinked, you might have missed it, and market has pulled back, but is holding near the high end of that range. But even today, with a largest ever 10-year note auction of $26 billion, market was unable to see those yields go up, and the yield curve actually flattened. So when you're issuing a record number of 10 years, you can't, the auction goes over, I'll call it a mediocre auction at best, you can't even get 10-year note yields to rise. This was going to be the reason why 10-year note yields were probably going to rise heading into the end of this week. We were going to see an auction that was probably going to have so-so demand followed by strong inflation, and yields were just going to pop. And step one hasn't happened. So yields didn't really move. They kind of remained unchanged. The yield, the 10-year yield, auction yield marked at about 296 and change. It's where we're trading right now. So really a non-event. And if you can imagine volatility, which has seen a sustained trade sideways, surprisingly, over the last several sessions, it's starting to resume that trend lower and nearing the year-to-date lows, or will be nearing the year-to-date lows, no doubt by Friday. So volatility now back resuming lower. The range is held, even, I think, through the biggest event of the week, which was the 10-year auction. And now we probably will see volatility test those year-to-date lows. We're not too far above them, and the market just seems very complacent and unafraid at this point. But we do have inflation data coming out Thursday and Friday, PPI and CPI. Those two could throw a little bit of a wrench into the trend if they come in stronger than expected. However, that's not likely to happen. And if it does, the Fed will probably have a few reasons why that's okay, and they can continue to slowly, gradually raise rates. I think that right now inflation, the Fed is very comfortable with inflation. We haven't seen any real gauges that have been red hot. The one concern is the wages component of the employment data that we've seen. That seems to have cooled off a bit. So that is the real inflation here. You can throw prices around because of the dollar trade and because of areas of the country that maybe are seeing different price swings. But ultimately, it comes down to wage inflation, something that this economy has started to see blips of, but certainly nothing on a consistent basis. So right now, the 10-year note looks to be heading into a range into the weekend. I know it's only Wednesday, but we'll probably hold this 2.80 to 3% range. Like I said, we are hanging on the high end of that range. So if those inflation numbers come in weaker, look out. We could make a run back towards 290 very quickly. This is Todd Colvin coming to you from the floor of the CME Group.